The president has made, he's posting this morning about that the tariffs are bringing back revenue, bringing back stability and strength to our nation. At the same time, the spending is still there, and it's increased in some ways because of the big, beautiful bill.
Late last week, a political earthquake shook the foundations of our economic understanding. The President of the United States fired the head of the Bureau of Labor Statistics, or BLS, right after they released their quarterly jobs report. The report wasn't pretty. It suggested a sputtering job market for the average worker. In response, the president claimed the numbers were phony and that he'd had issues with them for a long time. Now, here's the hot take. He's probably right, just not for the reasons he thinks. This isn't about a grand conspiracy or a plot to make politicians look bad. The real story is far more complex, and frankly, far more concerning for all of us. Because the truth is, the very numbers we use to fly our economy are becoming less and less reliable. So, how bad is it? And if we can't trust the data, what does that mean for our jobs, our savings, and our future? Let's break it down. First, let's look at what caused this firestorm. The July jobs report estimated the economy added about 73,000 jobs already, a disappointing number. But the real bombshell was in the revisions. The BLS admitted they had massively overestimated job creation in the previous 2 months. May's numbers were revised down by 125,000, and June's by a staggering 133,000. Poof! More than 250,000 jobs we thought existed simply vanished from the data. They were never there to begin with. Imagine your bank told you your paycheck was $4,000, but a week later said, "Whoops, our mistake. It was actually $3,000. That's essentially what happened to the national jobs paycheck. This isn't just an accounting error. It casts serious doubt on all the economic data we receive. And for many, it confirms a gut feeling. The economy feels a lot worse than the headline numbers suggest. To understand why this is happening, we need to look under the hood. There are 3 big reasons our economic data is failing us, and why it's probably going to get worse. The first reason is that our economy is changing faster than our ability to measure it. That controversial jobs report is actually made of 2 different surveys, the Establishment Survey and the Household Survey. The Establishment Survey is the one that gets all the headlines. The BLS contacts about 121,000 businesses and government agencies and asks a simple question: how many people are on your payroll this month? Sounds straightforward, right? But here's the problem. Large corporations with dedicated HR departments can often respond quickly. Many even have it automated in their payroll software. But what about small businesses? For a small business owner working 60-hour weeks, a 20-minute, completely optional government survey is not a top priority. As a result, response rates have been falling off a cliff. A decade ago, the response rate for the Establishment Survey was around 60%. Today, it's closer to 40%. So when the BLS publishes its first preliminary report, they might have as little as 55% of the total data they'll eventually collect. To fill the gap, they use something called imputed data, which is a fancy way of saying they make an educated guess based on past results. They look at the data they have from big businesses and use historical trends to estimate what the small businesses who haven't responded yet are doing. As any good finance bro will tell you, past performance is always the best predictor of future results. I'm joking, of course. This system of guessing is usually good enough in stable times. But it completely falls apart during periods of rapid economic change. Small businesses are the canaries in the coal mine. They feel a downturn first and are the first to lay off staff or go out of business. If the initial report is mostly based on data from large, stable companies while guesstimating the rest, it won't see those job losses until weeks or months later when the late data trickles in. That's when we get these massive, shocking downward revisions, just like the ones we're seeing now. This problem is being supercharged by the rise of the gig economy. The rate of new business creation has exploded since the pandemic. In the past, this would be great news. But today, many of these new businesses are just people registering an LLC for their side hustle as an Uber driver or a freelance graphic designer. These individuals aren't going to fill out a BLS survey for their side gig. This not only tanks the response rate further, but also makes the old assumptions for imputed data totally obsolete. It overestimates real, stable job creation and completely misses the bigger, more pressing reality. We could create 1 million jobs next month, but it doesn't mean much if you're working 3 of them and still can't call. make ends meet. The second reason our data is getting worse is both simple and cynical. It's profitable. While government agencies like the BLS are struggling, a massive private industry has emerged to fill the void. Large investment firms are projected to spend as much as $15.4 billion this year on what's called alternative data. That's more than 20 times the entire annual budget of the Bureau of Labor Statistics. What is alternative data? It's basically any information that isn't published by the government. These firms use private satellite imagery to count cars in Walmart parking lots, they analyze credit card transaction data, and they run their own surveys where they actually pay people for timely responses. The better their private data is compared to the public data, the bigger their advantage, what's known as data asymmetry. Now, this isn't technically insider trading because anyone could collect this information if they had a fleet of spy satellites and billions of dollars. But the average person doesn't. This creates a perverse incentive. The worse the public data gets, the more valuable the private data becomes. And what's one way to make public data worse? Cut the budgets of the agencies that produce it. After adjusting for inflation, the BLS has a 15% lower budget and 10% fewer staff than it did in 2010, even as the economy it's trying to measure has become vastly more complex. This isn't a coincidence, it's a cycle. Step 1. Cut the budgets of agencies like the BLS. Step 2. With fewer resources, they can't collect as much primary data, forcing them to rely more on those flawed guesstimates. Step 3. The reports become less reliable and require big, embarrassing revisions. Step 4. Politicians and private interests then point to these unreliable reports as proof that the agencies are pointless, justifying even more budget cuts. The average voter doesn't understand what these agencies do. The average politician loves to cast doubt on numbers that make them look bad, and the average data firm would love a monopoly on reliable information. Just look at the Bloomberg terminal, those iconic black and orange screens on every trading floor. A subscription for one of those costs about $30,000 a year because it provides access to data but regular people will never see. This brings us to our third and perhaps most important problem. Even if the numbers were perfectly accurate, are they even relevant anymore? There's an old saying, there are lies, damned lies, and statistics. The problem isn't just that the scorekeepers are having trouble, it's that they might be keeping score for a game nobody is playing. Take the official unemployment rate. To be counted as unemployed, you have to be jobless, available for work, and have actively looked for a job in the last 4 weeks. If you're so discouraged that you've given up looking, you're not counted. If you have a master's degree, but you're working 15 hours a week at a coffee shop to make ends meet, a situation known as underemployment here, counted as fully employed. The headline number, U3, misses a huge part of the story. Then there's the metric we're all taught to worship, GDP per capita. Gross domestic product measures the total value of all goods and services produced, but it has massive flaws. It doesn't account for inequality. If a billionaire makes an extra $1 billion while everyone else's income stays flat, GDP per capita goes up, but is the country better off? It doesn't account for environmental costs. Cutting down a forest to sell lumber boosts GDP, but ignores the long-term damage. And it doesn't include non-market activities like caring for a child or an elderly parent, which are vital to our society. The point is, we're clinging to long-running data sets because they allow us to compare today's performance to the past. But they are increasingly failing to capture the reality of life in the 21st century. So, where does this leave us? The narrative of a secret cabal of statisticians rigging numbers is a simple, appealing story. But the reality is a systemic failure. It's a combination of a rapidly changing economy, the deliberate underfunding of public institutions, and a reliance on outdated metrics that no longer reflect the world we live in. This isn't just an academic debate. These flawed numbers are used by the Federal Reserve to set interest rates, which affects your mortgage and car payments. They're used by the government to make policy decisions that impact millions of jobs. And they create a two-tiered system where Wall Street gets real-time, accurate data while the rest of us are left flying blind. Making good decisions, whether for a country or for your own family, requires reliable instruments. Right now, the gauges are flickering, the numbers are fuzzy, and flying is getting more dangerous for all of us. The first step to fixing the problem is admitting we have one. It's not a conspiracy, it's a crisis of data. And it's time we started paying attention. Thanks for watching. If you want to keep learning how the real economy works, don't forget to like and subscribe.